Guys, it is happening. It's in full swing. I just put a video out the other day on Google. Same thing is happening right now with Amazon. Everybody is getting crushed. All of these major tech companies are heading downwards, and I've been saying this, the same old story I've been talking about time and time again. Higher interest rates, tech companies, everyone's gonna start pulling back, and Amazon's no exception. Listen, guys, they just announced that they're gonna be cutting back on hiring any people like employees on the corporate sector because of uncertain economic conditions. And rightfully so. Guys, we are on the cusp of a major recession. And I've been talking about this for weeks and months and stuff like that. And it's quite evident here. But in doing so, and obviously this news comes out, what do people do? They hear this news and then they say, you know what, I don't like that. What I'm hearing, guys, it's not a good time at all to invest in a company that's like one of the biggest companies in the world right now. I'm going to just sell off because I got weak hands. Look at that. 52-week spread of this business, $188 a share, folks, for Amazon, and now it's sitting at $89 a share at the time of recording this video. Look at this drop off. Look at that. Boom. Look at that straight line right off the cliff. People are saying we are scared to hold on to this company. Why? Why? Half the stuff you buy is from Amazon. Half the stuff anyone buys is from Amazon. They're like the largest e-commerce shop in the world. Now, look, as a value investor, and if you're watching this channel, you must be a value investor as well. This is phenomenal. This is great. I'm laughing at this because this is what I'm talking about, folks. And there was never a quote any more truer. And wealth is transferred from the inpatient to the patient. And if you've been patient up until this point in time, give yourself a pat on the back, or better yet, subscribe to this channel, because all I talk about is just being patient and developing a strong mindset for situations like this. So with Amazon, you look, and this is the software that I use to actually just analyze this company. Let's go and do a cross comparison. Yes, they have been suffering quite a little bit. Their PE ratio is down compared to a 5-year average, which has been at 101.38. Now, that's obviously due to the earnings. However, these numbers here are both trading at a premium. We don't like that, but they've been pretty consistent with their EPS. They haven't been making much improvements. Their ROE is slightly down for the trailing 12 months, and same with their profit margin. It is slightly lower. Here's the thing with Amazon. They have amazing revenue growth. They have a very high return on invested capital, which is phenomenal. The free cash flow is down, but the net income is up. They have high ROE on average, and their EPS growth is up over the last little while. It's just currently down at the moment. But here's some things. These are some red flags that they have going for them. So those are the green flags that they have. The red flags is obviously the current ratio is low. So that means they don't have enough assets on hand to cover the liabilities in case of a shaky situation. But the debt to equity is also high, so that means they're taking on debt. And they're diluting you currently with the share dilution. So not the best qualities to have. So it is split down the middle. This score is out of 10, folks. So 5 out of 10 is not a score that I particularly like. But you also have to think about the factors that Amazon brings. And take a look at this stock price, $89. When was the last time we've currently had this price? It was roughly around the March 2020, the pandemic, when that eventually unrolled and unraveled itself to the world. From March 2020 till now, Amazon has been at the forefront of home deliveries, and they've been making a killing. You're going to tell me that this company and the revenue that it's been bringing in while people were at home and they didn't want to go out and shop because they didn't know what to do with all this COVID stuff, you're telling me a company that's been improving their revenue, improving all of these different items and their net income is now worth less. Is now worth less because they're taking a more cautious approach to a recession. Like I said with Google, folks, we want to find a recession-proof company. Now, e-commerce and Amazon, yes, this might get hit a little bit more harder than, let's say, a Google or whatnot. But actually, you know what? I retract that statement. Why would it get hit harder than a Google or another company like Meta or something like that? They sell everything. They sell everything. They sell consumer staples. You need to buy toilet paper or whatnot. You can get that off Amazon. You get literally everything off Amazon. Also, they have Amazon Prime Video, so you're well entertained. And they have all these different things in the pipeline. They have a gaming. They're going to be involved with gaming as well. They have all these different facets to make money. So this company is well diverse. So how are they planning to conquer a recession? Well, simply with the revenues that they currently have. Now, the problem is with this company is this company still trading at a premium? Ultimately, I've analyzed Amazon in the past, and my biggest problem was that the company was priced a little bit too high. 142. I can't remember the last time I analyzed this business, but for me, I like it when companies' prices go down because that means that they're at a lower risk. And take a look at this. That is, you're taking away 2 years of gains essentially from this business. But as we know, the revenue has been going up over the last 5 years, so you're not really taking away anything. Anyways, I'm going to stop blabbering about that. What I'm going to do, folks, is use this price analysis section of the software. I'm going to do a 10-year analysis. And what I'm going to do here, folks, is I'm going to put some assumptions in. And what we're going to do is get down to the very bottom and try to find an intrinsic value for Amazon and see what it should be bought at today. I'm very excited to put these numbers in. We'll talk about this in just a quick second, so stand by. This software here, if you want to utilize this software, head down to my website, leodeleo.com. The links are in the description box below. If you go there, follow the link. There's a coupon code FOUNDER, so if you input that, you'll get 20% off your subscription for life. But you can try it out 7 days for free, and it helps analyze companies within an instant. I get all this data updated like instantaneously. This is only the front page of the software. This is probably the main page that you'll probably use the most because it presents everything as a one-stop shop. There's many more features slated along the way, so definitely check that out. Folks, if you're enjoying the video so far, hit the like button, subscribe button. It means a lot to me. It means a lot to the channel. So if you are new here, this is what I like to do, folks, halfway through the video, and is to try to find the intrinsic value of this business. So take a look at this, folks. So with the software here, I'm doing 3 different assumptions: conservative, moderate, and aggressive, utilizing the historic averages of this business of, let's say, with revenue growth percentage, right? From a 1 year, 5 year, and 10 year perspective, profit margin, free cash flow, price to free cash flow, and PE ratio. So with these 3 categories, revenue growth, profit margin, and free cash flow, I'm utilizing these 3 different categories, the 1 year, 5 year, 10 year. With our price to free cash flow and PE ratio, I'm trying to find a very healthy number. So, and what I mean by healthy number is any number between, let's say, between 15 and 22.5. So for me, obviously the price of free cash flow is in the negatives at negative 34.57. I like to stick between the 14 and 18 rounds. So that's why I did 14, 16, and 18 for the price to free cash flow, because, and I'll explain that in a second. And PE ratio is the same thing, 14, 16, and 18. What I'm doing here, folks, is I'm putting these numbers at a fair multiple, because anything higher, you'd be buying this company at a premium. As I said, 80 PE is extremely high for me. I like to try to find something that's a little bit lower, so it's a little bit more fair, because I don't want to buy this company at a premium. I want to buy this company at a discount. Put my desired return at 13%. I'm going to click calculate, and take a look at this, guys. Take a look at this. And keep an eye here on my revenue growth numbers. My revenue growth numbers, I did 12, 14, and 16% revenue growth over the next 10 years. And take a look at what their averages are: 21, 28, and 25. So I put a discount in. And the current price is now $89.30. Average calculation comes out to be $87.48. Pretty much almost in line in the middle here between our moderate and aggressive categories. Ideally, we want to try to find something between our conservative and moderate categories, because that would give us the most margin of safety, and that's what we are trying to accomplish on this channel, folks. We're trying to find companies with a decent margin of safety to invest in. That way, in case we are wrong, we are not wrong so much. But take a look at this, folks. The current price is $89.30, and average calculation is $87.48. You could argue that this company is currently trading at fair value. Now, what am I going to do? I'm going to patiently wait. I'm going to patiently wait because I do believe that this company is going to continue to fall. Maybe it might have a small rally in a little while, but as interest rates continue to rise, as all of these bad things happen to the economy and we eventually enter this full bear market, I'm anticipating for this company to go lower and lower and lower. And my goal right now, if I had to buy this company today, I would wait for it to be between my conservative and moderate averages, and that's between $55 and $84.48. So where do I currently stand with Amazon? Same thing as I've been saying with my last little analysis. It's still my other analysis. It's still a little bit overpriced. It's still trading a little bit at a premium. Not so much anymore. Right now, it's almost at fair value, but I want that extra added discount, and I want to see how low I can actually go, because for me, that would give myself enough cushion for a future investment, and in case I am wrong. And this is the reason, folks, if you're new to this channel, the reason why I put such low revenue growth numbers in is exactly that. I could put 20, 28, and 25% revenue growth numbers, but as we approach this recession, it just doesn't make sense. This recession could be God knows how long. So I want to anticipate that revenue might be cut. They might not be making as much as they've done in the last few years. Because look, 2020 to 2022 has been phenomenal for this business off the pandemic alone, because everybody was at home. I can't anticipate those same numbers going forward. It just doesn't make sense. Those are outliers. Anyways, folks, that's the video. And folks, if you enjoyed this video, hit the like button, hit the subscribe button. It means a lot to me. And I will see you in the next video. Write down a company down below of a company you want to see evaluated. But better yet, as I said, grab the software and make your life so much more easier.